Good morning, everybody, and welcome to this specialist lending webinar. This is the fourth episode in this series of webinars. My name is Dan Morris. I'm Key Account Director at Crystal Specialist Finance. And as always, we've got the three amigos on. I'm joined by two very special guests. So the first one, essentially, he won't need any introduction because you'll all know him. We've got Roger Morris, Group Distribution Director from One Savings Bank. And then, as most of you know by now, we've got John McCaffery, the tax wizard, head of tax at Ltd Co. And again, he's a huge asset to these webinars. And he literally does know everything tax related. He really, really is a guru within that sector. So welcome, gentlemen. How are you?
Very well, thank you.
Very good, Dan. I'm really excited about today's session because we're really going to kind of learn loads, because this is really John to show about what we're trying to do. So yeah, very, very excited. And also it's the end of this next stage in stamp duty, Dan, and I'm sure there's going to be a lot of questions aimed at you about how maybe you can help some people who are desperate to complete, not just for the stamp duty savings, but for other reasons. So yeah.
Yeah, no, that's it. I mean, the main reason why we all got together for this webinar series was purely around the bridging and the stamp duty deadline, and obviously the taxation and I suppose the pros and cons of looking to do bridging finance versus your conventional high street residential mortgages. And here we are, kind of 4 episodes in. We've still got a really, really good following. So thank you everybody for that. And these events just seem to get better and better. So it's brilliant that we've built on something. We continue to go and hopefully continue to do these webinars, because again, the actual audience numbers are fantastic. So again, thank you very much. Now, today, in terms of what we'll be looking at, again, similar to every single one of these webinars, there's no format, there's no set agenda. We will literally freestyle and answer any questions that come in live, as much as we've had a few pre-asked questions. So thank you for that. Any questions that you do have, whether it's for me in relation to the specialist finance market, obviously Roger from a lender's point of view, but most importantly, we've got John from a tax point of view. And again, he does chip in around property transactions as a whole in general. Then you've got two really, really good minds, and then myself. So happy days from that point of view. There is going to be a bit of a focus today around the limited company buy-to-let market. Again, a lot of people asked last time, can we focus on that? Absolutely, we can, and we'll be discussing that throughout this episode. But again, we'll do a bit of a focus around bridging. So a lot of people, as I suppose we've had a conversation around probably about 5-10 minutes ago before we went live, have asked at the moment, obviously with the stamp duty deadline looming, or the first part of it looming at the 30th, end of this month, it's not going to get kicked down the road again. So we did kick the can down the road from the end of March. Now this is essentially going to be the end, or coming to the end. And can we still put an application in now and complete before the 30th of June? A lot of people have been asking. Now I'll field that question from a broker point of view, or from a packager point of view. And then Roger, you can chip in. And again, John, you, by all means, you can have your input, so to speak. But for us, if an inquiry still comes in today in terms of bridging finance, now it is touch and go at the moment. So obviously it's next Wednesday that the deadline is. However, if you set me a regulated bridging deal that needs to complete before next Wednesday, as long as there's a valuation already been done by, say, a mainstream lender, but ultimately it's not gone to full offer yet, or there's some sort of issue slowing the process down, then we can absolutely look to complete before next Wednesday. So that's absolutely fine. I've had a number of calls this morning from brokers ringing me saying, look, let's pull a rabbit out of a hat now. We've waited long enough. I'm not confident that this is going to get across the line. Can we do it? Again, we can absolutely do it on regulated deals if we do have a valuation that's done. Even if there's no valuation done, there's potential there, but ultimately there's less chance of it happening. Now, if it was a buy-to-let transaction, say sub 65%, 60%, then even if there's no valuation done as it stands, we can still look to complete if the inquiry comes in today before the 30th of June. Roger, what are your thoughts on that?
I think from a precise mortgages point of view, we've passed the point for us realistically to be able to take a new inquiry to be able to complete. We just don't have that capacity now in our processing time frame. And that's the thing I do admire you. You've got lenders and systems where it might not be the cheapest option as if you'd approached this a couple of weeks ago, where you could really take your time and there's less pressure in the system. It just depends, again, according to what solution. But I know your regulator offering that you've got, and it will be, the broker will have to commit to you. You know, it's not just like we can do it in 3 days and then disappear and go off for a cup of tea. You know, it's going to be an intense period where the client's going to have to work, and really the broker's going to have to get everything back within a very short time frame. But I have seen you do them in the same physical day. So that solution is there. John, have you got anything to add on bridging? I would normally assume not, but
no, not necessarily bridging. It's in terms of it's a couple of reminders on the tax points. So, stamp duty land tax (SDLT) is payable only on completion. So you have to complete the transaction to take advantage of the holiday. It's not exchange or anything like it. It's got to be the completion date. Capital gains is based on the exchange date. And I've had a few queries lately about people who've been saying, well, what if we exchange? Is it fine? In certain circumstances, and we have discussed this briefly in the past, there is still the possibility before deadline of doing an incorporation by a deed of trust. So the thing that tends to take time, I know you've got the mortgage issue, the thing that tends to take time is the legal process. You can transfer properties by deed of trust, sort your finance out with a bridge in the meantime, and then sort your conveyance out at a later date. So there are circumstances where you can still do a property transfer before next Wednesday if you are very quick.
So hang on, let's get this right, because we've said we've got I've written the 4 questions that we put in the marketing that we're going to ask you on, John, right? So everyone listening in, we are going to ask John these 4 questions, but I think there's going to be an awful lot of brokers just listen to what you've said there, and I know you're going to carry on to elaborate, but let's just take it that you've got 5 buy-to-lets or 1 buy-to-let, whatever it is, and we want to get the benefits. Do you want to just bring that alive about what you're suggesting and doing and how that would work with what Dan's doing?
If you are looking, so I think the circumstance whereby person-to-person sale, if you're close to a completion, I think your bridge will definitely sort that out. If you're a person-to-person sale and you're way down or you're way off, I think getting in before the stamp duty deadline is going to be problematic. Stamp duty is payable, as I said, at the point of completion. And unless you complete, you're not going to be able to take the benefit of the stamp duty holiday. Now, if you are looking potentially at moving your portfolio into a limited company, you may still have time. The way you could do that is via something called a deed of trust. Now,
John, can I just say there's a couple of guys saying they can't hear you too well. If you just keep yourself closer to the microphone, because obviously every single word at his own meeting. That's just for Stephen. And
I've got my volume on max, and I might try and dig in a microphone later if I can dig it out of my drawer, see if that works.
Keeping close to the screen does work,
okay.
And it looks far better for us watching you as well, John.
Nobody needs to see this. Right, so a deed of trust. Basically, tax works on the transfer of beneficial ownership of properties. It doesn't need a legal conveyance. It just needs to be where somebody, the owner of the property is now, beneficially transfers that property, and they can do it to a company. A deed of trust is a much simpler document and can be done in a much quicker time frame. So you can transfer a property to a limited company under a deed of trust and capture that completion date and therefore take advantage of the stamp duty holiday.
Wow. So I'm sat here now with Dan. We've got 10 buy-to-lets down. We want to move into a limited company because we've been given tax advice by you, John, to move into a limited company.
Yep.
However, imagine, Dan, having offers issued last October and we can't get them over the line because the lawyer was rubbish, yeah? We've seen that, haven't we?
Yeah. Yeah, we have, yeah.
Story for another day, but me and Dan were been working with a broker who's quite a good broker, but the lawyer was rubbish. So if me and Dan needed to get them across because we're going to save a lot of money, how would you set this up? What would happen? Can you arrange this deed document?
It's a lawyer. It's a different type of lawyer. It's usually the kind of lawyer that does wills and trusts and that kind of thing. Yeah. And yes, it can be done. So basically what they do is they set up a trust agreement between you as the owners, and the company as the beneficial owner in the future.
Yeah.
Now, I've just seen a question pop up there about can you do it if there's a mortgage on the property?
Yeah.
Okay. It would be fair to say that mortgage companies are not overly enamoured of this structure. And I would most definitely look to remortgage and refinance as soon as you can. In terms of the legality of it, the mortgage stays with the legal owner, which is the individual. But for tax law and basically contract law, the benefit of the property, the ownership of the property, moves to the company, and the obligation to pay the debt moves to the company.
Yeah.
So it can be done with a mortgage on it. In theory, the practice of it may cause you one or two problems. If you're looking at it as a short-term solution and could refinance relatively quickly after the end of the stamp duty holiday, it is entirely up to you, but you would have a discussion around whether or not you would want to inform the mortgage company and just sort it out in July, say.
Perfect. So if let's just say me and Dan had lender A on our buy-to-lets now, but when the sale and purchase goes through, once you've purchased the buy-to-lets into the limited company, the new lender is lender B. So lender B has already issued the mortgages, and it was literally just the legal process to go through.
Correct.
I assume you would use the same lawyer that would set up the trust document in theory, potentially.
You could use the same lawyer. It doesn't really matter. Basically, what would happen is that lender B would be lending to the company, and under the trust deed, the company has the obligation to repay the debt. So it would use that refinance to clear out the debt of lender A.
Right. Okie doke. Perfect.
Brilliant. There we go. There's another insight, which again, a lot of people may not have thought of, or it goes into a little bit more detail than some might have the knowledge of. So I'm just going to go quickly back through that chat, because there was a point that Stephen mentioned a while back now. So Roger, I'll aim this one at you for now. So thank you for this, Stephen. So by taking bridging instead of a mortgage to beat the deadline means changing the mortgage from a purchase to a remortgage. Now, what implications could that or would that have from your point of view, Roger, if any?
So by taking a bridge instead of a mortgage to beat the deadlines means changing a mortgage from a purchase to a remortgage. Well, no, I wouldn't see it like that. So if I'm it depends on what you're doing. So if I'm buying a property, I live at the moment, say in Stockton-on-Tees, and I want to buy a retirement cottage in Birmingham, and it's a purchase, the bridge, it could be purely and simply just on that purchase. So when we use the word bridge, it's short-term lending. So Dan could, what's your maximum loan to value on a regulated purchase bridge, Jan?
Oh, well, we're looking at probably between about 80 to 85 at the moment. That's literally just came this morning, hot off the press, 0.4% rates from.
Right, so if I've got 20% deposit on a purchase in Birmingham for a downsize, and remember, Stephen, a lot of the mortgages that Precise do is downsizing. So I'm selling a house for 600, and I've got no mortgage on it. I'm buying a house for 200. I've got a 20% deposit, so I don't even need to do what's called a cross charge. A cross charge is where you've got your current residential, which is in this situation worth 600 grand and it's unencumbered, and you're buying your new property for 200 grand. if you've got no cash available, the lender can take a charge over both properties, 800 grand's worth of equity, and lend the 200. That's a pretty easy one for Dan, but it does involve a bit more legal work and potentially 2 valuations. But in a situation where I'm buying a property in Birmingham, I've already got a valuation done on it, but that lender just can't turn it round in time, Dan could use that valuation, and it would be a purchase, Stephen, because we're buying that property. Where a remortgage comes involved is where you're raising the money purely on your current residential to buy the new one cash.
Just to stop you there, I think from my perception of that question would be the fact that, because let's just say Stephen's clients, I don't know, purchasing a new property, yeah, so they put a purchase application in. However, if they're then raising bridging finance against that purchase, so against the property they're buying, then in theory the application is redundant, isn't it? Because they would have to change it to a remortgage rather than a purchase application. So in theory, exactly, perfect. Now I think from my point of view is, again, you can correct me if I'm wrong because you're a lender here, but all that would need to be done is I suppose change that application from purchase to remo. And I think the only detriment to that client would be if that product is specifically for a purchase, not a remo or home mover. It's literally a purchase, first time buy, whatever that may be. Again, I don't know what your input from a lender point would be, but I don't think there'd be too many issues apart from maybe a reissue of a document.
Yeah, no, Stephen, you make a good point, and just now we're letting it sink in because I'm looking at when we do cross-charging. Cross-charging is technically taking a charge on a property you own, so you think that would be a remortgage, and a charge on a property you're going to buy. And we often get from brokers, is a cross-charge a remortgage or a purchase transaction? It's a cross-charge, and it's a hybrid of both. So that's where you're doing the short-term lend with charges over a property you own and a property you buy. What you've made a great point is, Stephen, is if you're proceeding with a high street bank and you're doing a purchase and you use a bridge, you then need to inform that lender it now converts to a remortgage. But I think if you're going back to that lender, speak to your lender BDM and explain that due to the time sensitivity, that if you don't complete, you'll lose the property because the people who are selling need to sell on that day, and they've got somebody else that would step in and say as a cash buyer, whatever the scenario, you would need to let that lender know. Now, there is lenders like Precise Mortgages, unless we use our bridging, we wouldn't allow you to convert to a remortgage until you'd owned that property between 6 and 12 months. So actually on a residential, we actually would insist that you've had the bridging in place for 12 months before we would class as a remortgage. Most high street banks will actually understand the time sensitivity, but that would need to be checked out in the first place. So it was a good question, that, Stephen. Thank you.
That's it. No, that's a brilliant comment. I just want to point out as well that both myself and Rog are not tax advisors, nor do OSB or Crystal give tax advice before we get shot. John, again, is obviously the main man for tax on here and the tax expert, and he is suitably qualified. So any questions that are getting asked and answered, John's the only one who can give actually legitimate answers. But no, perfect. Thank you very much for the comments and questions. So please do keep them coming in.
Dan, can we ask John the first question that we publicised through Dave when he sent out the marketing email? Is that all right?
Yeah, fire away. Over to you.
So the first question that we put out there, John, would be the following, and I do love this one. So you've got Dan's coming into you today and into a broker's offices, and Dan is a first-time landlord, first-time buyer. So Dan, let's say hypothetically, Dan lives with his parents in like a granny annex. He's single, he's on good salary, he's got a good deposit. The buy-to-let he wants to buy is easily 2.5 times his salary. So it's not a backdoor residential, it's a buy-to-let. And Dan wants to keep this buy-to-let for the rest of his life. He's not intending on selling it. Now, apparently, it's one of the top search questions, first-time buyer, first-time landlord. And a lot of brokers will automatically just go and search what is the cheapest rate for Dan. And that normally comes up with one of the big high street lenders like HSBC, NatWest particular, even Woolwich. NatWest is the one I always seem to get passed back because of their rates, but it's in personal names. So do you want to kind of really give your view? First-time buyer, first-time landlord, not going to sell ever, and yet hasn't bought their first residential. What would the implications or your tax advice be?
Gosh, a lot to go at there. Just before I do that, I did see another question pop up in relation to what I just said. And just to kill that off quickly, the question was whether there'd be 2 lots of stamp duty on the transfer via a deed of trust and a conveyance. And there won't. It's only on the deed of trust. The conveyance, stamp duty is payable on the beneficial ownership. Right. So, first-time buyer, first-time residential, and keeping the property forever. Right. Forever's a long time, and you've got to generally consider what your various circumstances are. So I think, as I've said in all of these, tax advice is always worth getting, and it's very, very much specific to the individual circumstances. Okay? So a couple of things to pick up on there. If he's a first-time buyer of a first residential property, there is some stamp duty reliefs available for first-time buyers of their own home. And if you buy your first-time property as a buy-to-let, then you forfeit that right. Okay? So you've got to be aware of that as a first-time buyer. If you're buying your first property, it's a buy-to-let, you will pay stamp duty and you forfeit your right on your own home to save some stamp duty. Who knows if it'll still be around in the future. Okay? The next thing you've got to look at is, and we do this with a lot of clients, is you've got to look at the whole of the circumstances around that particular person. Okay? By that I mean, so they're single at the moment, but are they getting married? Are they looking to inherit at some point? The job is decent. What are the earning prospects? Are they higher rate taxpayers? Is it worth their while setting up a company and all the hassle and it would incur of doing annual accounts, doing annual corporation tax returns? Is it going to be their only property? Are they just buying one buy-to-let, or are they setting themselves up for a lifetime of portfolio management? Is their plan to stay in their well-paid job and have a couple of properties, or is their plan basically to move out of their well-paid job because they're funding it and they want to become a full-time landlord? Each and every one of those questions is going to have an impact on the tax advice. And you need to get a really, really good feel for how they answer and how they currently plan for their life to pan out. As my
John, just to make it easier then, Dan, the point I think I want to make in a simplistic bit, Dan's going to buy his first buy-to-let today.
Yeah.
But you know he's going to want to come back and buy a residential in about a year's time.
Yeah.
And the implication of maybe that first property being in personal names, if I'm right, would trigger the extra 3% stamp duty when they buy the residential. Because one of the biggest common points brokers will do is focus on the rate, advise personal, but not document that knowing that Dan will come back and buy a residential further down the line, not document that will trigger the extra 3%. And then when a complaint comes in, the ombudsman rules and the broker has to end up paying that extra stamp duty because they didn't advise the customer, or more importantly, get the customer to come to see someone like you. So do you want to kind of just...
Yeah, no, and I agree with all of that, Roger. It's very much, it's the loss of all the stamp duty reliefs and the additional stamp duty you would end up paying on top. Now, and if they've got a decent salary, now if they are getting their next residential in a year, a company is most likely a good idea. It still protects them from the 3% on their own purchase. And it may enable them to get the stamp duty relief as a first-time buyer. Yeah.
Yeah.
But you've got to note that the company is paying 3% on that first purchase.
Yeah.
So it's always a balancing act. Always a balancing act. It's a question of, is the 3% on the first purchase going to be more than the stamp duty on their own property? Most likely in most circumstances.
And what Deepak's asked, John, if you were to buy your first property, your first property is as a buy-to-let, is standard stamp duty payable as a first-time buyer, first-time landlord?
Yes, it is.
But then obviously on the back of that, from what you just said there, then the extra and additional stamp duty is payable on your residential purchase.
Correct.
Right. So if you were to complete on your first ever buy-to-let today, first ever property, and it was under 500 grand, you wouldn't pay any stamp duty.
No, no, that's correct.
Yeah. But what we're saying, John, and Deepak as well. So if you were buying, let's say you're buying your first ever property today and completing today, and you had no other properties at the end of the transaction, and it was under 500,000 in England, I must emphasize in England, you wouldn't pay any stamp duty. But then if in November you were to purchase your first residential for 500,000, you'd lose your first-time buyer allowance, John, because it's your second home. Yeah. So you pay standard stamp duty plus the extra 3%, and that extra 3% on 500,000 would obviously be £15,000, and therefore it has the, is it 15,000? My mind's gone now. Is it 15? Yeah, 15,000. So the emphasis would be, it's about understanding all those points, John. So do you want to just, carrying on? Just remember, me and Dan are only asking questions. We're not advising in any way. The expert here is John. So John, do you want to maybe just sort of simplify what we've just said up to now and then carry on with those points? Because it's hard to know what a person's going to do in their life. But normally if your first property is a buy-to-let, it's because you aspire to build in theory. But this is where we need to come and sit with you. And John, if it was me or Dan coming to you for the first time, and we obviously need to and want to pay you for tax advice, can that be offsetting your accounts, the costs we paid you?
Sometimes it can. Yeah. And generally, you will find that a tax advisor will invoice for tax advice, most of which is deductible. If it generally relates to the property, you just sort of add it to the cost of the property and deduct it later when you sell. So you will get a deduction at some point.
Great, and it's in a limited company, it works the same. It's deducted at the end.
Yeah. Or you might get it as ongoing, so kind of like remuneration. So the tax advice can be deductible, yes. I think as you've alluded to or tried to simplify down there, it's the decision. So at the moment we've got £500,000 stamp duty holiday. If you buy your first property during that and it costs less than £500,000, you're not paying any stamp duty.
Yeah.
If you buy a second property and it costs, say you bought it tomorrow, it costs less than £500,000, you still have the stamp duty holiday apply to your standard stamp duty, but you're paying an additional 3%.
Yeah.
Right? If you buy it in 3 weeks, it's up to £250 that's relieved from the stamp duty holiday, but you're still paying the 3% if you already own the property.
Yeah.
Right? The other factor is there is still a relief available for first-time buyers if you live in the property. So if you bought the buy-to-let property in your own name, you forfeit that relief and you pay standard rates depending on where the holiday is and the additional 3%.
Yeah.
Or you can buy your first buy-to-let property in a company. The company is entitled to the 500,000 standard rate stamp duty holiday.
Yeah.
But it will pay the additional 3% regardless. But that still preserves your relief for a first-time buyer for your own residential property, if that came second. And if you're on a good salary and you're going to be a higher rate taxpayer, it's generally a good idea to hold properties in a company if you're going to build a portfolio.
Brilliant.
But not always.
But not always, no.
We just had another comment in there on the back of that, so I'm guessing it's getting people thinking, I suppose, around scenarios, etc. So again, Deepak, thank you for this. So if a first-time buyer buys a buy-to-let property through a limited company, as the company owns a buy-to-let property, if the individual then buys a residential property to live in, is higher stamp duty payable, even if the buy-to-let is owned by a company? I know the answer, but I can't comment, so...
Was your answer going to be no?
Yes, it was going to be no.
Yeah, no, the company is deemed to be a barrier between you and the property ownership. So you're only deemed to own directly properties you own in your own name. So you can have as many companies as you like, as many properties as you like in a company, you would still have the various reliefs available as a first-time buyer if your first property ever, it has to be ever, is bought in your own name.
Deepak, I think I understand why you asked the question. There is a lot of lawyers who really do make a mistake on this. And what the lawyers will say, that John sets up a limited company, which is I Love Buy-to-Lets Limited, and he buys a buy-to-let. Because John is 100% shareholder, he's arm's length, he still owns the property. And that's where some lawyers actually think that they believe that's correct. And it's not, it's black and white. It's who owns the legal ownership on land reg is the legal owner, because shares can be bought and sold in a limited company. Like I could buy the shares off John and then I own the shares. And in effect, if I own all the shares, in effect, I own the property, but its legal ownership remains in personal names. It's like having shares in BT or Virgin. So lawyers do get it wrong, and that's why you've just got to have the conviction. What I would say is the land stamp duty website has a very clear system which asks, who owns the property. There's no arm's length transaction discussion. And again, why John makes a very good point. So hopefully that answers that question, Deepak. It does, John, that comes up so often, doesn't it, Dan?
It does. It doesn't. What I was going to say on there, we still get people these days saying they want to transfer, not buy and sell a property from individual names to limited company. Well, it's not a transfer. It's a sale and purchase. No. I've been advised by a great tax advisor. It's a transfer. Well, it's not, because again, Dan Morris owns Dan Morris Limited, but ultimately we're two different entities. It's two different ownership structures. And again, as you mentioned there in black and white, who's on the title deed? It's as simple as that. So don't get drawn in by someone who's saying that there's no stamp duty, CGT, all that sort of stuff on the back of it's a transfer into a limited company, because it absolutely isn't. Again, John, correct me if I'm wrong, because that's my opinion, but
no, that's absolutely spot on. The only thing I would just tweak a little bit on what both of you have said there is that it goes back to my earlier point. You can transfer a property to a limited company beneficially. So it's not necessarily who has the legal title. Yeah. Who has the beneficial ownership.
Yeah, that's a very good point that you've made there, John, is that you can transfer through beneficial interest. I think what Dan and I are referring to is we often get told it's a remortgage by accountants. John owns it in personal names. John owns a limited company. So we're going to remortgage it into the limited company, and we're going to do what's called consideration, and we're going to transfer it through for the mortgage value, not its open market value. And we get that a lot. So just remember, guys, there's 2 points. It is a sale and purchase, but when John talks about the beneficial interest, that's a more complicated process than just what me and Dan get as general questions.
And just speaking around tax. So again, this one's came in yesterday around tax. So taking all the advisors back to their CMAP days, or hopefully, there's different ownership structures, and Johnny, you'll be very familiar with this. So could you tell me if, husband and wife, partners, whatever, own a residential property. They own some buy-to-lets. The benefits of owning them in tenants in common versus joint tenants and vice versa.
From a tax point of view, there's not a lot of difference, right? So if you've got a husband and wife who own buy-to-lets in tenants in common or joint tenants, right? The revenue will deem, regardless of the actual ownership, the revenue will deem that they own it 50-50. Okay? So if you are looking, so you've got one spouse who earns significantly less than the other, and you're looking to move more of the rental income to that spouse, right? Even if the actual ownership is 99-1, the revenue will deem it to be 50-50. Right. In those circumstances, you need to have some form of legal documentation, right? It can be tenants in common, it can be joint tenants, it can just be a deed of trust between a husband and wife, right? That gives a different ownership than 50-50, right? You complete something called a Form 17. It's a form the revenue have. And if you've got sufficient evidence, the revenue will agree that the ownership isn't 50-50. Now, the key point to that, the absolute key point to that, is it can't just be the rental stream that transfers. The capital ownership has to transfer as well. So you can't just say, I'm keeping 100% of the property and transferring 95% to my husband or my wife of the rent, right? If you want them to have 95% of the rent, they have to have the beneficial ownership of 95% of the property.
There he goes. There he goes. Great answer.
Can we make a couple of health warnings here as well? With Form 17, I know because I've done that myself.
I know you have.
Form 17, John's helping with this, and I massively cocked up. The moment, so if John was to transfer the beneficial interest, let's say for 4 properties, pull a number out the air, and you've got to, the lawyer dealing with it would register a charge on land reg under a Schedule A notice to say that there's this beneficial interest being registered. You need to, on the day that the trust is registered, do Form 17, and it's an electronic document. So you've got to fill it out that day, not your accountant, unless your accountant offers that service. You as a couple, if you want to be taxed on an unequal basis, need to do it on the day that the trust document's registered. And then you've got 60 days to get it sent to the revenue, John, and right. You need with it that evidence. So send with it a cover letter as why you're doing it, and a copy of the trust document that John, for example, would have set up. So you've got everything. You've got Form 17, but the Form 17, that being able to receive the income will only start the moment that form is filled out. You've got 60 days to send it through, but a lot of people, including me, didn't do the form at the start when it needs to happen. So,
yeah, the thing is with that, it's, again, for a lot of advisors, it's outside your remit. You literally look after the property transaction, and then off you go from a client's point of view. But if you do want to add more value to your relationship with that client, and I suppose do the full holistic advice point of for that transaction, then again, using someone like John is going to be invaluable. By no way, I mean, well, do you know what? It's a plug for John and working with him. But the only reason why I'm doing that, and I very, very rarely mention partners that we work with, is because John is a massive asset, and I can actually sing highly and be confident that if anyone did want to link up with John after this, his details will be sent across to you, because I know there's been a lot of interest from a tax point of view, and he is definitely one of the best out there.
What I would say, Dan, as well, is when the revenue did the risk assessment in 2015, that was issued after the Chancellor's announcement of interest relief being removed, it was estimated that 4 out of 5 landlords would be unaffected by these changes. And the reason the revenue did that calculation is they assumed that 100% of landlords would go and see the wizard or a tax advisor like John and actually get that tax advice. And in a situation where you've got applicant one earns 150 grand a year and applicant two who looks after the property but is, say, a house husband or a housewife and not using their tax allowance every year and sending their tax allowance unused back to the revenue would assume that they would receive tax advice, and the tax advisor may suggest going tenants in common, doing the trust document, and then the proper process being allocated to that person who's a basic rate taxpayer. And that's why the document was so robust. So really, I suppose the bit you would advise, John, is see a tax advisor.
I would. There's one final point I'd throw in on there that I come across all the time, and it's another common error I find with transfers of properties. Transfers of properties between spouses can attract stamp duty. Stamp duty. People think stamp duty is paid on the value of a property. It isn't. Stamp duty is paid on the consideration you give for a property. And that can include taking on a debt. So if you want your spouse to take 95% of the rent and you're mortgaged up to the hilt, in order to get the tax relief on the mortgage, your spouse has to take the mortgage obligation on as well. If that mortgage obligation breaches the standard stamp duty thresholds, the spouse pays stamp duty. So at the moment, you can transfer up to 500 grand of value per property over to your spouse. And we've got a stamp duty holiday. Come 1st of July, you've got up to 250. When we go back to normal stamp duty, you can transfer up to 125 grand of mortgage, but any more than that per property, and you're paying stamp duty.
And so just to be clear, guys, just because sometimes you can hear it and think, did I hear that right? Between husband and wife, you only pay basic stamp duty according to whatever the rules are. You don't pay the extra 3%. And between husband and wife, you don't pay capital gains. John, there's a question coming from Deepak again. Yep. Is there any way or an option to transfer, sell an unencumbered property portfolio? So what Deepak is saying, you got 5 buy-to-lets, all unencumbered, and what Deepak's asking is they want to put them into a limited company without paying stamp duty. Is there a way for this to occur?
Highly unlikely. Highly unlikely. There are other advisors out there who say, yes, there are. The only real way you can do it is if it's a transfer from a partnership, and that partnership has been in existence for at least 3 years. The next follow-on from that is, well, I'll just put a partnership in place for 3 years. And you can do that. But if the revenue spot that you've only put the partnership in place to save the stamp duty, they'll unwind the whole thing. So it's possible, but not likely. Any other way that isn't. Now, what he can do and potentially save a bunch of stamp duty, or limit it at least to 3%. There's if you're transferring 5 properties, there's a relief known as multiple dwellings relief. And what you do in that circumstance is you can take the average price per property and you pay stamp duty on the average price, not the total value. So that can significantly reduce your stamp duty cost, but you're still paying at least the 3% in that circumstance.
Dan, Deepak and John, I think what will be worth on the next webinar we actually do a session on partnerships into limited companies, novation of debt, and multi-dwelling relief, Deepak, because to do it properly and to explain about the different implications, there's 3 things to think about when moving properties into personal to limited: stamp duty, capital gains, and the big one that everyone misses is ERCs, because you've obviously got to redeem the existing debt unless you can novate. And there is lenders will let you novate, but very few will actually do it. So I think we'll pick that up, Dan, on another webinar. And in that way, we can let Tax John do real justice about explaining that and give us some costs, because it's not cheap. If you can do it, John, there's a lot of work that you've got to put in. This isn't just a 5-second job. I know how much work you've got to put in on that one. So what other questions do we have to cover off, Dan?
We've got a couple. So Tracy asked a question prior to the webinar saying, I have a lot of inquiries on all of your products and I'm looking for a contact to refer to. So I believe that'll be aimed at you and OSB.
What I would say, Tracy, is two things. One, I love your surname. I think it's an amazing surname, really do. Second, I would say to you is the Crystal Mortgage Desk has the most comprehensive set of experts that really understand the commercial market, and they would really be able to take you through how our products work and feel. There is on the InterBay commercial website the list of your regional BDMs. You go on, you put in your postcode, and it'll bring up which of the BDMs that would actually look after you, and they can take you on that process of running through. So I'm going to advocate, speak to the Crystal Mortgage Desk, or ring Dan. Dan's an expert on InterBay, as many other lenders. Send him an inquiry through, because I'm only going to sell InterBay products and say that they really are great products, but sometimes the LTV, the criteria, the rate could be better off with another lender, and Dan will give you an impartial view. But so the option is ring Crystal Mortgage Desk, ring Dan, or look on the InterBay commercial website for details of your local BDM.
Yeah, no, exactly that. And again, there's something to be mindful of, the fact that we do get a lot of semi-exclusives from a lot of these lenders and lender partners. So again, you could be doing your clients a bit of an injustice going direct to certain specialist lenders in the market. I'm not saying everybody, I'm not saying you have to use us for every transaction because it's going to be cheaper. It's absolutely not. And you've got your relationships with certain lenders, as you do, that are within your sweet spot and comfort zone. But anything that you want a second opinion on, or actually, do you know what, the sourcing systems aren't quite getting it right in terms of the and it's got this and this and this. You want a personal underwriting approach, again, speak to us. Now, a lot of stuff that we do, just for those of you that haven't used Crystal before, it's human underwriting, so it's not a tick box. We've got our own sourcing system, but then we've also got our own underwriters in that particular sector in the specialist market that know every lender's criteria inside out. And if it doesn't quite fit with them, when you said, I want to place a case with, say, InterBay, but actually there's part of the criteria that's not met, they'll absolutely let you know. Whereas sometimes the sourcing systems won't. You'll get down the line, similar to what we mentioned right at the beginning, where you've got a flat above a shop that might source straight away on the likes of TMW on a buy-to-let basis. It goes out to valuation and it gets valued as nil, because actually there's a laundrette next door to one downstairs. So again, it's something that if you may not have the experience in terms of that property type, ownership structure, or LTVs or whatever, then again, speak to us, because I sound like a bloody call, an advert here. There's no obligation quote, but it is. So we're not doing any dips, any searches or credit footprints on the client, but we can get you the best terms that are available in the market. And a lot of the time we get the clients a better interest rate, and actually you get paid the same, if not more. And you certainly get paid more on bridging finance coming to us. So it's just something to bear in mind. Another question that's came in previous to this, and I am conscious of time because we've been almost at an hour, and I know a lot of people are busy, especially with the deadline next week. Sue, this is a good question, so thank you very much for that. If a commercial / warehouse / industrial unit has a good lease with a good tenant, why are lenders so reluctant to lend on them?
What I would say on this one, Dan, is if it's a big warehouse near a motorway and it's just full of cardboard boxes, you and I with a pallet truck could empty it in seconds. It's pretty fluid. It's just storage. Then that type of warehouse will most likely have the vast majority of the market interested. But let's just say that warehouse hosted Aztec Zeneca, and it was making, of all things, the virus, the antivirus within that warehouse, but it was full of machinery and plant, and it was absolutely full of, little vials and chemicals and everything. That actually is a risk for a lender, because all right, I'd think it'd be pretty impossible for AstraZeneca with the current desire for such a product would go bust. But the answer being is a factory unit that's full of heavy machinery or full of machinery, if you had to repossess, you'd need to sell it with vacant possession. You know, the insolvency people might sell it as a going concern, but if it went all the way through and it was repossessed, people just want a blank canvas. So a lot of the times it depends on what that business does. And I think it's about knowing the lender's appetite. And that's really the beauty of the Crystal Mortgage Desk is, you know, InterBay Commercial, you could ring me up and I'd better tell you within seconds if it's the type of property we want. And a lot of the times lenders will cherry pick according to what's inside that building. And that's where the Crystal Commercial Mortgage Desk will have that insight track, won't they, Dan?
Yeah, exactly that. I mean, we do get a lot of people send us these sorts of deals, and I suppose now more so than ever, but it is down to appetite to risk and what sort of tenants either in that unit, that store, what category retail trading it's at. There's a lot of factors in that. Now, if you've got a 10-year lease with a really good firm with a 5-year break clause, brilliant, but it depends on the desirability and the of that particular unit, so to speak. And obviously commercial has been hit massively over the past 12, 18 months with obviously COVID, and we still don't know what the new normal looks like in terms of the market and what a lot of people are going to be doing. But if the business has been affected by COVID, and again, I know people are sick of jumping on about it, but it's still very much here, then the lenders that are going to lend against that particular proposition, there's few and far between in the market, because again, it is a huge risk. And if people have just started to go back over the past few months, cash flow might be a struggle and they could go under within the next 12 months. So for what I would say is, if from a commercial point of view, if it's had to close during COVID, which the majority of the market has apart from your retail spaces, so your corner shops, your quickie marts, your supermarkets, then ultimately the rate's going to reflect the risk of that sector, unfortunately. But again, we can still arrange finance for any form of business, any form of commercial. As long as you can't teach or pray in it, then essentially we can help that client with that scenario, loan to value dependent. But loan to values have actually returned now to pre-COVID levels, which is good. It puts a bit more confidence within the market and within our sector. So again, that's across the board for commercial, bridging, development, resi, buy-to-let, everything. It's starting to return back to normal, which is fantastic. So hopefully that covers your question off. But again, if you want to pick it up after this, then please give me a call. Okay. Right, so time for one more question then. So multiple registrants have asked and said they're seeing a lot more declines for self-employed and debt consolidation cases. Can you give an overview from a lender's point of view of why that would be?
Well, I think it's because the lenders just don't understand the self-employed. They would look and think, oh, we can't actually read a set of accounts. We can't look at the salary, the dividend, add back car allowance or private pension contributions, or just understand the self-employed at the moment. Precise Mortgages and Kent Reliance and InterBay Commercial will all consider debt consolidation. In speaking on Precise Mortgages' point of view, it was with the self-employed, we'll do it on 1 year's accounts, we'll do it with adverse, and we'll happily capital raise. With Kent Reliance for intermediaries, we'll do 1 year's accounts and work on up to 30% of that first year's figure on a projection. So if your first year you were on 30 grand worth of income and the second year you were on 60 and you had a good relationship with a proper chartered accountant, we could actually work on a projection on that second year's income. And with both brands, we're very happy to capital raise and very happy to be able to take that overall view. And we will allow recent or current adverse, particularly unsecured arrears. So for us, it's great news that high street lenders are turning these applications down, Dan.
No, that's it. And the more and more of them will. And more clients will become specialists, unfortunately, because what we do know is there's more money in circulation. There's more debt within the economy, which ultimately means from a default and an adverse point of view, there's going to be more adverse credit, unfortunately. Now, what I will say on the self-employed limited company directors, whatever that may be, is just make sure you are confident in terms of telling the story about that client, about their circumstances, about that income. Even if there's a loss within that that company that year or a downward profit turn, as long as there's a justifiable reason and it's understood as to why. So it could be reinvestment in the business, buying machinery. Obviously, COVID's not a brilliant answer, but things like that. Then, if we explain the story in a way that a lender understands it and that you would lend your money to that individual on the basis, then a lot of the time it can be overcome. But it's how that case is packaged to that particular lender. Now, I'm not saying we're the best in terms of sending stuff to lenders perfectly packaged every single time, because we're not, but we do understand how certain lenders work and our relationships do have a bit of pull with certain lenders. And again, we're seeing a lot of people at the moment where, again, tax advisors, right, okay, keep this money, only draw out bare minimum from your limited company. But actually, a couple of months down the line or a year down the line, when they've only drawn 30 grand that year because they don't need it, well, I want to buy a house. Well, unless you've told a tax advisor or an accountant rather that your plans are 12, 18, 24 months down the line that you're going to buy a house, so you need to increase your income to be able to afford this £500,000 house and you're earning 30 grand a year, it doesn't make sense. We can actually use now the actual profit from the business plus salary, which a lot of lenders in the market won't use at the moment, but we've got that availability. So even if they're not drawing it out from a tax point of view, which we completely understand, we can still use that income and that profit. So again, bear that in mind from a residential point of view. And I think that's a bit of a golden nugget from me. But yeah, I think we'll wrap this up now. There's no more questions to answer, I don't believe. No, there's not. I mean, from my point of view, I'll summary in a second. But guys, thank you very much for your input today. It's been really, really good and very insightful, especially from yourself, John. I learn every single time from you. And there's questions that are asked that we think John's not going to have an input on this, and you absolutely do every single time. And again, it's invaluable. But do you guys want to wrap up from your point of view before I do the closing statement? John?
Yeah, it's just 2 comments on the last thing you said there, Dan. It's I work with entrepreneurs and they have murder getting a mortgage. And it's really good to hear that there are some lenders out there who will look at profits in a company, because I have some very, very wealthy clients who take minimal income because they don't need it and are having real difficulty getting mortgages. And it is, they don't understand. It's your lender does not understand how your company and your income works. So it's great to hear that you can provide that service.
Absolutely, absolutely. By the way, I wasn't doing that saying I'm that wealthy client, because I'm not.
Neither was I, but we as a lender and you as a packager, we have solutions to help, Dan. I mean, all I would say is, listen, John, you were outstanding today. We've got a load more questions to ask John on the next webinar, which will be on incorporation tax relief, multi-dwelling relief, and the pros and cons of consideration of moving properties from personal name to limited company. I think it's going to be top of that list, agenda. So that's it from me, Dan. Over to you.
Yeah, that sounds like I would say a fun-filled webinar. It's not going to be, but it's going to be fun. It's going to be insightful, and it's going to add another string to your bow, and again, be able to help you give that holistic information, not advice, information to your clients, and add value to your business. But again, yeah, just in summary, really good session. Thank you very much for your comments, saying you've enjoyed it. Again, we love doing these sorts of sessions. You'll receive an invite and you'll see the marketing and information go out for the next session. That's going to be in a month's time. It's going to be the same time of day, same day of the week. So please do come on. Hopefully you found it useful. After today, you'll get John's details sent across to you, and you'll obviously get everyone else's, and you'll get your CPD certificates. Again, use and abuse my firm for all your inquiries. If you think you've got something daft, you probably haven't. And if you have, brilliant, we'll use it in these sorts of webinars moving forward to educate the market. Again, if you want to link up with a fantastic tax advisor, the wizard is always available. And again, he's one of the best out there. Otherwise, he wouldn't be on this webinar. But yeah, that's it from me. Thank you very much. Have a good day. Enjoy the sun. And it's coming home, hopefully.
Take care.
Thanks a lot, guys. Bye.